Listen-only mode.
Hi, everyone. It's Rob Booker. Glad that you are here this evening. Welcome to tonight's webinar. My guest tonight is Stephen W. Bigalow. He's a professional analyst with over 30 years of investment experience, including 8 years as a stockbroker with major Wall Street firms. More importantly, he's the author of some fantastic books, Profitable Candlestick Trading, Candlestick Profits, Eliminating Emotions with Candlestick Analysis, and High Profit Candlestick Patterns. He's a member of the AAPTA, American Association of Professional Technical Analysts, and he's a published expert in stocks and commodities, Futures Magazine, Trader's World, and London's Morning Star. He's my guest tonight. He's here to talk about not missing out on profits, not losing the profits once you have them. I'm super happy to have you here, Steve. Welcome tonight.
Well, thank you, Rob, and welcome everybody. I started as a stockbroker over, I guess it's now 35 years ago, and got out of the business because I realized that most brokerage firms didn't know any more about when prices were going to move than we do. So I got out of the business, and then somebody dropped candlesticks on my desk. At that time, I was buying, renovating, and selling property in Atlanta, Georgia. And they said, "You were a stockbroker. Take a look at candlesticks." And I figured anything that was as sophisticated sounding as candlesticks couldn't be worth looking at. But they kept bugging me until I finally picked up the information he dropped on my desk, which was fairly antiquated, and said, this is making sense. So I started, let me see which button here. I started figuring out which of the candlestick signals you could really make profits from. Now, out of the candlestick universe, there's about 50 or 60 signals that the Japanese rice traders developed or observed to tell us that those were reversals. And when I was asking people back then, they had made so much sense to me. I'd ask people on these investment chat rooms were just starting many, many years ago. I'd ask a rhetorical question: why isn't everybody using candlesticks? And the answers came back that there was too many of them and they didn't always work. And I always worked off the premise that if they didn't work, we wouldn't be looking at them today. So I went through and I started learning candlesticks the hard way. I was learning candlesticks, every detail that I could. And unfortunately, I was learning them at a time when there wasn't anybody that I could go to and get a second opinion. And I tell people back then the only time I could get a second opinion was when I would go to the doctor. I'd say, "What's wrong with me?" He'd say, "You're fat." And I said, "Oh, I think I want a second opinion." He goes, "All right, you're ugly too." So in studying the 50 or 60 signals, I discovered there was only 12 major signals that you had to learn. And the basic premise of the candlestick signals were that they work because all they are is the graphic depiction of investor sentiment. And investor sentiment never changes when it comes to investing. So what I'm going to try to do tonight is go through to identify fast-moving stocks, what actions you can see very plain at support and resistance targets, how you identify pullbacks versus a full-scale reversal, and how you use candlestick signals to analyze a trend. So I tell people, don't try to take notes because there's lots of charts and we go fast. It's more just to kind of expose people to something that really makes sense in investing. What it boils down to is, and I'm going to use the term stocks, whether you're trading Forex, commodities, bonds, tulip bulbs, anything that has fear and greed in it, there's only one thing that moves prices, and that's not fundamentals. It's the perception of the fundamentals that move prices. So the most important aspect about candlestick analysis is that the signals are the accumulative result of all the knowledge between all the participants that are buying and selling a trading entity during that specific time frame. Now, that specific time frame is very flexible. Candlestick signals work just as effectively on a 1-minute, 3-minute, 10-minute chart combination as they do on a daily, weekly, or monthly chart combination. So I'm going to go back to just the very basics, and the basics are that the Japanese rice traders can you see my cursor on the screen?
Yes, I can.
Okay, good. All right. The Japanese rice traders, instead of using notches, used the open, and if it closed above where it opened, it created a white candle. If it opened and closed below where it opened, it created a dark candle. That did not necessarily mean that the price of the trading entity was up or down during the day. It just told you what happened after the open. This is very, very valuable information and gives you a ton more insight into what's happening in a trend than just normal bar charts. So what we're going to do is we're going to go through the 12 major signals, and as we go through, I'm going to show indicators that work very well with candlesticks. So what are we really looking for when we're trying to find a good trading program? Basically, we're trying to find what is going to signal us, or signal that there's a big potential gain, when to get in and when to get out. Now, a lot of people will show you, oh yeah, we made big gains here and made big gains here. I'm not interested in what happened here. I'm interested in what happened here that told me to get ready for this big price move. So the first major signal that is most, I guess, most well known in candlesticks is the DOJI.
Mm-hmm.
The DOJI is where the price opens and closes at the same level during a time frame. And I'm going to use the most of the time frames on this as daily, but as I say, they can be used on the 1-minute chart, 10-minute chart, hourly chart, whatever you want to use for whatever time frame you're trading. If the price move is huge during the day and it closes right at the same level, that's called a long-legged doji. A dragonfly doji opens at the top, trades down, comes right back up to the top, looks like a dragonfly. And the Japanese rice traders say a gravestone doji is formed when the warriors come out of camp, they go into battle. By the end of the day, they're beaten back into camp, leaving the dead all over the field, thus the gravestone. A derivative of the doji is what they call the spinning top. It's got a little body, but it still represents the same thing. There was indecision between the bulls and the bears that day. So they came up with some very simple rules that if you see a doji at the top, it's time to sell. If you see a doji at the bottom, you need further bullish confirmation to tell you that there's been a reversal, or the weight of the market could continue to push the market trend down. Always pay heed to a doji, and here's the one that will make you tons of money. Very simple. The trend will usually move in the direction of how they open the next day after a doji. So I'm going to show you how that happens. The nice thing about Japanese candlestick charts is that it graphically shows you what's going on in an investor sentiment. Where do most people buy? They usually buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So my term for overbought and oversold condition is stochastics, and I use stochastics of 1233. You have an uptrend, and you see a big price move in the overbought condition, start looking for a sell signal. Then we have a doji. Very simple. The next day, if they open it lower, you close out the position immediately. Now, as you can see, my charts aren't very, don't have too much on it. My charts have the 200-day simple, 200-day simple moving average, the 50-day simple moving average, the 20 simple moving average. These are the moving averages that all the money managers around the world usually use to make their decisions for their portfolios. The advantage we have with candlestick analysis is we can see exactly what's going on at important technical levels based upon what signals are occurring at those levels. The most important technical level we have is what we call the T-line. It's the 8 exponential moving average. And very simply stated, if you see a candlestick buy signal and a close above the T-line, you can stay in this trade until you see a candlestick sell signal and a close below the T-line. You can stay in a downtrend as long as you see a close below the T-line until you see a candlestick buy signal and a close above the T-line. Makes for very simple or comfort sleeping at night, knowing that you're in the right direction as long as you have that combination doesn't occur. One caveat to that is that the further you move away from the T-line, the higher the probability you're going to come back and test it. So the further you move away from the T-line and you see a candlestick potential reversal signal, it's time to take profits. Where do people buy? They buy exuberantly at the top. So if you see a gap up in the overbought condition and see a doji, it's time to take profits. and it sticks out like a sore thumb. It's where the bulls and the bears have finally reached equilibrium, especially in the overbought area. If they open it lower the next day, you close out the position immediately. A gap up in the overbought condition, you start looking for sell signals. DOJI followed by a gap down the next day, you want to be out of that position. The bigger these signals are in any of the candlestick signals, the more compelling there's going to be a reversal going the other way. Here's a long-legged DOJI. Just huge indecision that day, big volume. They open it lower the next day, it's time to take profits. If one long-legged DOJI means great indecision, a series of long-legged DOJIs means greater indecision, you're probably ready to see a reversal. So using gaps, candlestick signals and gaps are your best friends. Probably speaking to the wrong crowd, but most people are told that if you see a gap, stay away from it because you don't know what's going on with the price. With candlestick signals and gaps, you'll make a ton of money. If you see a DOJI in the overbought condition and they gap it down the next day, it's time to be out of that position. That day of indecision and a gap down not only told you there was indecision, but told you with force which way they've made their decision and what the trend's going to be after that. The abandoned baby is when you have a gap up DOJI in the overbought condition and they gap it right back down the other way. That's a very powerful reversal signal. Gap up in an overbought condition, start looking for a sell signal. Look for the gap down. If one DOJI means indecision, a series of DOJIs means more indecision, and when they make up their mind which way they're going to go, it's usually with a good force in the opposite direction. So again, a DOJI at the top, take profits. A DOJI is at the bottom. You need to see bullish confirmation, excuse me, that the bulls have started to take control. Now, again, notice what's happened. We'll get to this sell signal, and it closed below the T line. Now look how far away you've moved away from the T line in the oversold area. You see a DOJI, they open positive the next day. Where do you think your first resistance is going to be? It's basically going to be right up here to the T line. If it fails there, if you bought here and it fails here, you're back out of the trade. This is the nice thing about candlestick signals. Through the 35 years I've been in the investment business, I've heard tons of professional money managers tell you to cut your losses short and let your profits run. In that 35 years, I've never heard one of them tell you how you cut your losses short and let your profits run. Candlestick signals do that very easily for you, very mechanically. Have some very simple rules of when to get in and when to get back out of a position if it's not working. And we'll go through some of that as we go through this. Oops. A gap down in the oversold area. It's time to start looking for a buy signal. The gap up, again, there's your abandoned baby. It's going to have a very strong reversal signal. A gap down DOJI hammer signal, which we'll get to. When they remember though, the simple rule of a DOJI is they'll move it in the direction of how they open it the next day. If they open this positive, so you've got a DOJI that's forming down in an oversold condition and they're gapping it up the next day, they've changed the investor sentiment on that trend. If you see them gap it down in an oversold condition, that tells you that's the exhaustion. That's the panic selling at the bottom. Start looking for a buy signal or buy confirmation. And if, again, one DOJI means indecision, a series of indecisive trading tells you it's time to watch for a change of direction. Here you have a series of DOJIs in the oversold area followed by a bullish confirmation candle, number one. Number two, closing above the T line. Makes it very simple. They break out of this downtrending channel with a buy signal. You stay in it until you see a candlestick sell signal and the close below the T line. Or, again, the main basis of candlestick signals is we can see exactly what's going on in investor sentiment at major support and resistance levels, like the 200-day moving average. So if we're looking for that gap down and that gap up with candlesticks, it gives you a high probability for two reasons. It gets you in immediately. You don't have to wait for confirmation like some technical trading programs. I was asked the other day, how many days do you have to wait before you confirm? It confirms by doing exactly what you expect it to do or anticipate it should do after a DOJI. A DOJI in the oversold condition If it opens positive, it's going positive that next day. A gap down in an oversold area, that's the exhaustion. They've reached the state of equilibrium. If they open up positive the next day, that tells you the bulls are starting to take control. Again, that series of dojis and a close back up above the T line tells you the trend has been reversed. Doji at the top, take profits. Doji at the bottom needs confirmation. If one doji means indecision, a series of dojis means greater indecision, and this is where we make tons of money. The trend will usually move and how they open it after that doji. Now, the combination of what we're going to get to is a bullish engulfing signal. A doji followed by a bullish engulfing signal is what we call the left-right combo. This is a little jab of indecision. This is the roundhouse right. It usually starts a very strong uptrend. Little jab, bearish engulfing signal is going to start a very strong downtrend. I should have told everybody, don't be afraid to ask questions as we're going along. If Rob sees questions, he'll interrupt, and I can answer them right at that time.
Yeah, absolutely. Don't hold off if you got questions. If you're thinking about applying some of these principles, or a term seems unfamiliar to you, or you want to ask about something that you watched pass by a few moments ago, just shoot. Anything on your mind, go ahead and contribute. And if the question doesn't fit in exactly right away, I'll save it for later and make sure I ask it near the end of the presentation. But,
right. I'll be glad to stay as long as everybody has questions afterwards.
Okay, that's great.
So here we have a left-right combo right on the 50-day moving average with stochastics in the oversold area and trading back up above the T line. This is the perfect combination for getting into a bullish position. Essentially what the candlestick signals do is get you in and out at the appropriate times because they are the identifying factors of when there's been a change of investor sentiment. The bullish engulfing signals where they open it below the previous day's close and close it above the previous day's open. This body completely engulfs this body right here. And when you see it, it sticks out like a neon sign. It just tells you there's been a change of investor sentiment. You're usually going to start a strong uptrend. The bigger the signal is, the more compelling your uptrend is going to be. Bullish engulfing signal in the oversold area, big bullish engulfing signal, and a close above the T line. Anticipate a strong uptrend. There's your left-right combo with a close right at the T line. Makes this very simple for your entry strategy. What do we expect to see after a candlestick reversal signal? We expect to see the bulls are still there. So the next day, if they gap it up, they're gapping it up after confirming the left-right combination signal, number one, and moving above the T line. That's full confirmation that you want to be buying. What would get you back out of this trade? The Japanese rice traders make it very simple. If this is your bullish signal telling you that the bulls are in control, the bears should not be able to close it more than halfway down this candle. If they can, the bears are still in control. You get right back out of the trade. Left-right combo, very strong uptrend. Bullish engulfing signal, right on a major moving average, support level. It's time to be buying.
Hey, Steve.
Yep.
There's a great question that I think asks something that you covered at the very beginning, but many of the people who are in attendance may have missed. Could you back up one chart and perhaps show us once again what you call the T line?
Okay, let's see if I could go previous.
And then perhaps go back through each moving average.
Right. The 200 is the red, the blue is the 50-day moving average, and the gray is the 20-day moving average. Again, these are the moving averages that most money managers, not most money managers, all money managers around the world use for making their decision in their portfolios. They work very effectively when trading stock or commodities, bonds, or currencies. It just seems that everybody watches the 200, the 50, and the 20. The T line is short for our trigger line. It tells us that if we see a buy signal and a close above the T line, you can stay with it as long as you don't see a candlestick sell signal and a close back below the T line. That's the 8 exponential moving average. This is probably a combination of the Bollinger Bands or Dave Elliott's Mobo Bands It's kind of more concise, and it works extremely effective. This was created or discovered by one of my first private training students that came down from Anchorage, Alaska. Really loved candlesticks, went back and tweaked it, and a few months later he came back and said, "Hey, look at this 8 exponential moving average." And when I tested it, I was making good money before the T-line. I'm making excellent money now that he introduced me to the T-line. Okay, the bearish engulfing signal is when they open it above the previous day's close and close it below the previous day's open. This black candle completely engulfing the previous day's body. Now, not necessarily the shadows, just the body. If it does engulf the shadows, it's that stronger a signal telling us there's been a reversal. The bigger the signal, the more compelling your reversal is going to be. It also gives you some techniques for knowing simple investor sentiment that the Japanese rice traders show in their graphic depiction. When do people buy? They buy exuberantly at the top. So it makes it very simple. If you're getting up toward the overbought area and you see a gap up, very simple stop loss processes. If this opens and starts trading higher, you put your stop loss right one tick below where it opens. Because if it goes up and stays up there, that means something good's happening. If it comes back down through the open, it's going to create some sort of candlestick sell signal, whether it's a shooting star, a dark cloud, a bearish engulfing. So very simply, you put your stop loss if it comes back down, or if it opens up here and immediately starts selling off, you put your stop at where it closed the night before. If it comes down through that level, that tells you the sellers have taken control. There's, again, your bearish engulfing signal after a doji, left-right combo, and look how far away you are from the T-line. Makes this very simple. After this day, you probably want to take profits because you can watch it to see what it does once it comes back to the T-line. We've got one pattern that we'll show, which is called the J-hook. If it supports here on the T-line and starts coming back up, we can get right back into it. Now, my third book that I wrote was about how to get your emotions out of your trading. My emotions always were, oh boy, I'm in a winner, I'm going to buy a new car, I'm going to buy new golf clubs, this is going through the roof. And then I say, oh man, it's pulling back, but I don't want to take profits here, because what if I took profits and it went right on up without me? That's where I'd hang on to it until I broke even on the way back down. Now I have at least the insight to say, all right, that's a sell signal. The probabilities tell me it's time to take profits. And now I can visually see if it's time to stay out of the trade or get back in on a J-hook pattern. So it helps me immensely get the emotions out of my trading, which is the whole purpose for me developing my system I did with candlesticks, because I was one of the worst investors in the world until candlesticks came along, because I could see graphically where I was the panic seller at the bottom or buying exuberantly at the top. Now I know to do exactly 180 degrees opposite. There's a left-right combo right here at a major resistance level. Stochastics turning over. It's time to be going short. Left-right combo right here at the 50-day moving average. Time to go short. The hammer signal. There's only one formula you need to know in candlestick analysis, and that is the number 2. The tail on a hammer signal is 2 times greater than the body. The body can either be black or white, but essentially it tells you that the bears have hammered out the bottom and the bulls have stepped back in. What do we want to see to confirm this signal? We want to see that the bulls are participating the next day, starting the uptrend.
There's a good question that came through.
Go ahead.
And I know you don't mind me interrupting, Steve.
Yeah, go right ahead.
First of all, I love that you're just blowing through this stuff. I mean, this is a huge amount of information, so I'm thrilled. Like I've done presentations before where everything just moves along at a snail's pace, and I feel like, okay, I'm following you really good. I want you to keep moving. So this is absolutely fantastic, and I love it.
All right.
So we're getting a lot of positive feedback from everybody as far as that's concerned. A question that's come through several times is, the daily charts are great. I mean, that's great for long-term analysis. I thought I heard you mention that everything that you're sharing here could work equally well on the shorter time frames also.
Yes. This chart you're looking at right here could be a 1-minute chart, or it could be the daily chart. They'll look all the same.
Okay.
None of the criteria changes on any of them. The moving averages stay the same. The stochastics stay the same.
Great.
It's I guess, what's the word, fractal.
Yeah.
That everything is works equally well. I used to trade the E-minis off the 1-minute,
Right.
3-minute, and 10-minute chart combination.
Right. If we removed the time frame from the top of the screen, this could actually be any time frame chart, and we wouldn't really even know the
Exactly.
difference.
Yes.
I want to share with you one more observation that is, I'm sure, shared by everyone that's here, Steve. Without a question, this is the clearest, to the point, non-rambling presentation I have ever seen. Thank you. Thought you'd like
thank
that,
you.
Steve. So there you go.
Well, as you can tell in my voice, I get excited. As I say, I used to be the worst investor in the world. I contributed so much money to the markets, and I kept thinking, why the heck am I always buying at the absolute top? And how come when I sell a position at the bottom, that was right at the very bottom?
Mm-hmm.
So I got out of the business. I was a stockbroker, so there was a whole slew of clientele out there that you could still feel sorry for. And then when candlesticks came along, it just turned me around 180 degrees and it made me realize that prices do not move based upon all this gobbledygook that Wall Street tells you to look for. Good managed companies, or that the fundamentals of something is improving. That doesn't mean a hill of beans. It's what everybody thinks is going to happen. What their sentiment is going to move that price.
Well,
and all this is a graphic depiction of investor sentiment, and all we have to do is identify it and use it. And I mean, it changed my whole investment career. I mean, I could make a very good living, or I do make a very good living, just trading off of the charts.
Well, it's just fantastic. There's a few more comments, and then I'm going to let you get right back into it. But this is a great time since we've paused a little bit. I'll ramble a bit, and then I'll turn it back over to you to get it clear and concise all over again. A few observations. I'm a Forex trader primarily, and let me tell you, folks, the questions that came through about Forex. Yeah, I've spent the last 7 days in preparation for this presentation tonight, looking back over Sunday night gaps in the Forex world. And the observation that Steve's making here are absolutely directly applicable, even to the Sunday night gaps that we had just a few days ago, actually, in the FX market. So you're going to see gaps primarily in FX just on Sunday nights, or in the Sunday open, or the Monday morning open in Asia. Absolutely applicable, no question whatsoever. You'll just see fewer of them, but they're definitely going to be applicable. I want to give you another comment, Steve. This rocks. The solid content is valuable. Thanks to Rob for sharing it. And there's a question that you might want to answer at the end, which is, which book should a candlestick novice read first? There'll be some other questions later, Steve, but I'll turn it back over to you.
Okay. I usually tell people, read the High Profit Candlestick Patterns. That's the green cover book. That's got the meat in it. And then if you want to really refine it, then go back to my first book, which was High Profit or Profitable Candlestick Trading. And then if you're having problems, I mean, the reason I wrote the third book was because I was a mental mess when it came to investing. So I knew what most people's problems were. Why some people won't pull the trigger once they've, analysis paralysis.
Yep.
Or why some people won't take profits. Or why people get in too late. So what I discovered was all those things that had been inhibiting me from making profits before candlesticks came along, the candlestick signals kind of clarified when I should be doing certain things, and it does it on such a mechanical basis and with simple logic that it took all the emotions out of my trading. There will still be times where I'm thinking, oh man, this is really going good. I've got a good profit. Oh boy, I'm going to buy something when I sell this. And then all of a sudden, it's not doing what it's supposed to. Normally I say, oh, it's going to go back up and do what I think it's. But then I have to stop and say, wait a minute. What is the chart telling you? And right now I'm seeing a sell signal in a high probability situation. Close out the position. There's going to be another trade tomorrow and the next day. There's the nice thing about candlestick analysis is that I can analyze 7,500 trading entities every night in less than 10 minutes to have the best one or two trades ready for the next day.
Right.
Because the formulas and the scans were so simple.
Well, that's just awesome. There's a lot of questions coming through about stop losses when you have a moment.
Yes, we will go. I'll be hitting some of those as we go through here.
Excellent.
And stop losses are very simple. If on any chart that you look at, say if this is my buy signal and it confirmed the next day, if this was the signal that told me that it was start looking for buyers, where should it not close? It shouldn't even trade back below this level. So I can, if I'm buying right here, because I can see it's confirming, I immediately put my stop right here because it should not come back in this direction if it's a bullish signal. Now, the probabilities are, with everything setting up, we're going to have an uptrend. But that's the term probabilities. That doesn't mean guarantee. There's still going to be losses. The one thing that I learned, had to get through my head as an investor was that because I was smarter than everybody else, when I did my analysis and thought a stock should go up, when I bought it, it should go up. Again, because I was smarter than everybody else. And then when it turned around and went the other way, I'd keep thinking, all right, people that aren't as smart as me aren't seeing the logic of owning the stock just yet. I'll just have to wait until they do. And it'd keep going down, keep going down, keep going down. Finally, when it hit the bottom, I'd say, get me out of this. Take a big loss. And what most people usually do is people that are accustomed to taking losses, they get into a position and now it's profitable. What's the first thing they think of? Boy, if they let this go to be a loss, boy, would I look stupid. So I'm going to take my profits real quick. And that's called eating like a bird and pooping like an elephant. So what candlestick signals taught me was, where are the probabilities of when is it time to get in for an uptrend and when is it time to get out? Now I can get through the emotional hang-ups of, if this goes against me, that simple rule of cut your losses short is right there. If this is supposed to do what it's supposed, or what the signals tell us it's supposed to do, it should be going up. If it turns right around and goes back down, it's not doing what the signal told us it should be doing. You close out the position immediately. So that means probably out of every 3 trades, 2 of them are going to be profitable. That means immediately I know that one of those trades is not going to be profitable. So I've already got that in my head, that if a trade's not working, that's part of that 33% that didn't work. Get out of the trade and go on to something where the probabilities are in your favor. So anytime I see a signal, bullish confirmation, I'm expecting which direction it should go. I'm not looking for it to come back down, back through the signal. I'm looking for the obvious. If I see the tails of hammers hitting right on a support level and coming back up, what's that telling you? That tells you every time I hit the support level, somebody out there with big money is starting to buy those positions. The tail to the downside is the indicator. Stochastics are my people say, well, how much weight do you put on the signal versus your confirming indicators? Probably 85% of my analysis is what signal am I looking at. Then the rest of the analysis is, where are the stochastics and where's my T-line? If I'm buying on the positive trade the next day, where do I think my first resistance should be? Up here at the T-line. If it goes through, I know I've got a good trade. If it fails, I know the T-line is still acting as resistance. I'm right back out of the trade. Hammer, DOJI, bullish confirmation. This is not rocket science. These are just graphic depictions that the Japanese rice traders, the Japanese rice traders family that developed this, didn't become rich. They became legendarily wealthy in Japan. They were the powerhouse for years or centuries because of candlestick analysis. So anytime I see the signals, it's just a simple if-then statement. If I see a candlestick reversal signal, then I should see bullish confirmation. I want to be a buyer.
And how does the T-line factor into these 2 trades that we see on the chart right now? Okay,
if I'm buying right here, it's supporting off the 200. It's well below the T line. Where do I think my first resistance level might be? Up here at the T line. So I know that if I'm buying a candlestick buy signal, that I got to watch to see if it can get through the T line. If it does, I continue to hold because I know I've got a good strong uptrend. If it fails here at the T line, that tells me get out of the trade, that the T line is still acting as resistance in the downtrend. Oops. Okay, that was the hammer signal. Let's see. This is the hanging man's signal, which is the same as the hammer, except it's at the top of a trend. They call it a hanging man because there's his head and there's his legs dangling down. Mm-hmm. So there's a reverse psychology here. The bulls are happy, the bulls are happy, the bulls are happy. Then, oh, man, they're a little bit nervous. But by the end of the day, they bring the price back up toward the top of the trading range, and the bulls are relieved. The next day, they open it lower. The bulls say, shoot, the bears are still here. Get me out of this trade. And that starts the downtrend. Hanging man, next day they open it lower. That tells you the sellers are starting to take control.
I like how if you decide that you're going to hand over the decision making to the expression of market sentiment that is contained inside of this candle pattern. I like that if you decide to do that, you really do eliminate the emotion. You don't argue with it. You don't worry about any lost gains. You don't worry about missed opportunities because, of course, it can continue going in the same direction. But you're really, if you decide to do this, you're siding with the probabilities.
Exactly. And these signals we would not be looking at them today if they didn't work. They've been around for 400 years. Now, a lot of people say, well, why hasn't everybody been using candlesticks? Because a lot of people are still just learning about candlesticks. They were introduced to the United States about 25 years ago. I just happened to stumble across them right about that time. But this is just the graphic depiction of what's going on in investor sentiment. And that's the only thing that moves prices is investor sentiment. And you don't have to know a lot of technical analysis to understand the signals. I tell people all you have to do is be able to see, and you can understand what's going on in a reversal signal. It's almost like the old couple that are getting ready for bed, and she's standing there naked in front of the mirror, and she says, look at me. My face is wrinkly, my breasts are sagging, my arms are thin, my butt's scrawny, my legs are spindly. She turned around to her husband and said, is there anything you could say about my body that would make me feel good? And he goes, well, your eyesight's still pretty good. So I tell people, as long as you can see, you can analyze candlesticks very well.
Does volume have any role in what you do?
No, volume has the only volume that is a added plus is anytime you see a reversal. If you see a big volume spike the day of, the day after, or the day before, or the day after, that usually tells you that there's a lot of stock that has changed hands. And that's an added plus. I mean, that's another little fluffy to tell you that probably a reversal has occurred. A lot of people say, oh, I want to see the volume or I want to see the price go up as the volume goes up. Volume has nothing to do with price. If you're trying to buy a trading entity that nobody's willing to sell, of course you're going to pay up for it. And it may not have very much volume for that price to keep going up. So the volume has nothing to do with a price movement. Let's see what else we got here. All right, here's a piercing signal. Piercing signal is very simple. It opens at or below the previous day's trading range. That's different than the bullish engulfing, where it only had to open below the previous day's close, and closes more than halfway up the candle. That number 2 again, the halfway point of this candle. That's your piercing signal. Starts it up. The further they open this down here and bring it back up, the more compelling that your reversal has occurred. The bigger the signal, again, the bigger the probabilities that you've had a change of investor sentiment. Just very simple. That what did this tell you? When you saw this gap down in an oversold condition, start looking for a buy signal. The opposite of the piercing signal is a dark cloud. It's where it gaps up above any of the previous day's trading and closes more than halfway down this candle. And as again, this was where when you see a gap up in an overbought condition, if they take it up, I put my stop right here. If they open it up here and started drifting it back down, I put my stop right where it closed the night before, because if it comes down through there, it's going to create some sort of candlestick signal. They shouldn't be gapping up in an overbought condition and start selling it off. If there's something good happening, they should be gapping it up and taking it up further. The bigger this signal is, the more compelling that the reversal has occurred. When you see a gap up, start watching for your sell signal. What's the worst case scenario? Worst case scenario is you take your profits, it comes down here. As soon as you can see a candlestick buy signal and a close back up above the T line, you can start buying. Here's a case where they took it right back down. That tells me they failed at the T line, start going short. Now again, these type of signals, you won't have as many gaps as in Forex trading, but you're going to get a majority of the signals that will work in Forex trading because of the constant flow. So it's just like trading the E-minis or the YM during the day. You're not going to have gaps, but you're going to have a lot of the signals occurring that tell you exactly when there's been a change of investor sentiment. Again, there's that gap up above any of the previous days trading, closing more than halfway down that candle. Here's the shooting star. Looks like a shooting star. There's the body. Again, the tail is 2 times greater than the body. What do you want to see the next day? Well, if they open it lower, you get out of the position immediately. Where do you think they're going to take it to? They're probably going to take it back to the T-line. Notice how far away you moved from the T-line. Just the probabilities are great that if you saw a potential candlestick sell signal, they're probably coming back to test that line again. A gap up, an overbought condition, a DOJI shooting star, they're probably coming back down. Are they going to support here? We don't know. Why take the chance? You can always take your profits up here, and I have no qualms about taking profits, see it bounce, and getting back in, even if I have to pay higher for it. At least I know when I paid higher, I'm still in a position where it's going in the direction I expected without having to worry about whether it's going to do this type of thing on the support of the T-line. Shooting star. Time to get out of the position. These are just, when you start seeing the tails to the upside, that means the bulls are trying to take it up, the bears keep knocking it down. As soon as they close this below the T-line after sell signals, you know you can go short until you see a potential reversal signal, which was a gap down doji in the oversold area. It's time to take some profits. Now, I say it's time to take some profits. I always had a hard time taking profits because I was worried things would keep going in the direction. So I've at least modified that by, if it's time to take profits and I'm hoping that it's going to go up further, I'll take off half the position, because I can rationalize that if I took off half the profits, let's say we had a shooting star up here, I'm taking off half my profits, because if it keeps going up, at least now I'm in half a position still making money in a high risk area because it's overbought. I can sleep with myself if I take half here and take the other half when it opens lower. All right, I got most of my profits. I'm not trying to sell at the exact top or buy at the exact bottom. I'm looking for that fat part in the middle. When I got the fat part in the middle, I just go on and find another situation that looks like this, where I know the probabilities are in my favor to make some money. The bigger this signal is, the more compelling they're going to take it back down. You see it occur right on a major moving average or a support or a resistance level, that tells you the story immediately, what's happening in investor sentiment at that level. The inverted hammer is the opposite of the hanging man. It's where the bears are happy, then all of a sudden they're trading it up, and the bears are nervous. But by the end of the day, they trade it back down, and the bears are relieved. The next day they gap it open to the upside. The bears say, shoot, the bulls are back here again, get me out of the way, and that usually starts a very strong uptrend. Very simple. If it gaps up and starts trading up and you buy into it, where should it not go? It should not come back down below this level, because that's exactly what this signal is telling us, is if they open up positive after an inverted hammer, it's probably got a 95% probability that you're going to go positive from that level. Inverted hammer, bullish engulfing signal, close right at the T-line. It's time to be buying. Inverted hammer, harami, which we'll get to the harami. The next day they open up positive, you want to be a buyer. Where do you close out? Well, if they couldn't get through the T-line and traded it back down, you close out the position. My whole trading strategy is I want to take on my losing trades either flat small gain or small loss. On my winning trades, I want to make a good sized profit from it. The bullish harami is where they open it inside the previous day's close and close it. I did this backwards. They open it above the previous day's close and they close it below the previous day's open. In Western terminology, that's called the inside day. In Japanese, that's harami, which means pregnant woman. There's her body and there's her little belly sticking out. And if they do that right on a major moving average, if we see it open positive the next day, it tells you exactly what the big money was doing. They were buying once it got back to the support level. And if you see that bullish harami that tells us the selling has stopped, and they see a gap open the next day, that pretty much tells you exactly what's in investor sentiment, that they're now stopped selling and they're buying with aggressiveness. You want to be in that position. Buying after candlestick signal and gapping up, if you know what the signals are telling you, there's lots of people say, well, I don't want to buy a stock or a position that's up 3, 5, 7, 10, 15, 20, 30%. If I see a candlestick buy signal and a gap up, I want to buy immediately because that tells me exactly what's going on in investor sentiment. There's going to be a lot more after that. So very simply, stop losses. If here's our signal, bullish harami, the next day the bulls confirm by closing up above the T line and confirming the bullish harami. The next day, what happens? They close it more than halfway down this candle, the candle that told us the bulls were in control, and close it back below the T line, get right back out of the position. You're in a bad probability situation. The bearish harami opens below the previous day's close and closes below or above the previous day's open. Tells us the buying has stopped. Start looking for selling after that. Bearish harami, buying has stopped, selling starts. On something like this, I make it very simple. I may take half of the position off here and say, all right, if they come back down through the low of this harami day, that tells me the sellers are in control. I want to be out of the position. The bigger the signal, the more compelling that the uptrend is over. There's a hanging man harami. You can give them as many names as you want as long as you recognize that if you start seeing selling after that, it's time to be out of the position. So you see the bearish harami followed by a gap down. Tells you not only is the selling or the buying stopped, but they're anxious to get out of that position. Close it below the T line. Notice they can't close it back up above the T line. It's time to go short.
Hey, Steve, this is fantastic stuff. There's lots of comments coming through. This is not going to be a new thing for you, a new experience. There are some latecomers that would love a reminder about what the T line is.
Yep, the 200 is the red, the 200 simple moving average. The blue is the 50-day simple moving average. The gray is your 20-day moving average. That's what most of the money managers around the world use. The T line is what we call that's the 8 exponential moving average. That's our trigger line. Very simple. If we see a candlestick buy signal and a close above the T line, you can stay in this as long as it doesn't close below the T line. So we may have been out here, but now we saw what we see right here, a DOJI right on the 50 with bullish confirmation. We're back in with the same criteria. If it failed here at the T line again, we're back out. But it got back up above it,
right?
Until we get up here to another sell signal.
And my friend David asked in the webinar here, well, what's the process for managing the trade? And it sounds really straightforward. It sounds like what you're doing is using that T line, that 8-period exponential moving average, as the helper in managing this trade in the trend.
Exactly. The T line is probably some sort of derivative, as I say, of John Bollinger's Bollinger Bands. John was on one of our sessions just a couple months ago, and he basically said they use the range of Bollinger Bands, whereas the T line just uses one simple trading level. It simplifies things, and as you can see, it works very effectively. It has dramatically improved my trading, because there's times where I get a little bit nervous and say, all right, here I've got an indecisive day that just closed below the T line, but our stochastics are still not overbought. That makes it very simple. I've got to make a decision. If it opens lower the next day, I'm out of the position. It needs to open higher and trade higher for me to stay in it, and that would have held me in the trade. It just as we could go through tons of charts, and it would show you very effectively how the T line works as a trend. What do I say? Trend supporter. And we'll see more of this as we go through. I don't know what number we're on, but as long as you people don't fall out of your chairs asleep, I'll keep going on.
I don't think anybody's fallen out of their chair asleep. I think, in fact, I don't think people, frankly, Steve, I don't think people expected that I would bring you on here and you would be as unbelievably generous with the information that you are communicating. So,
well, the reason I like to show this, no matter what you're trading, as long as there's human emotions involved, you're going to make money. Whatever trading system you have right now, if you overlay candlesticks on top of it, it's going to improve your vision of what's happening in price trends tremendously. As I say, this is not rocket science. This is just common sense put into a graphic depiction. Did I skip a morning star? I did. This is the morning star. This is our next signal. Morning star is where you have a dark day at the end of a downtrend, a day of indecision, and the third day has to trade positive and close more than halfway up this candle. Now, notice how we have a DOJI gap up. That's your best friend. Anytime you see a DOJI followed by a gap up, you want to be buying. You know where your stop loss is. It's right here. They shouldn't trade back below this level. And if you have a day of indecision followed by a gap up, that has a very strong probability you're in an uptrend. The further you close up above the halfway point, the more compelling that your uptrend is going to start. And if they gap this up on the third day and take it up, and notice in this case, oversold condition, we have a DOJI Morningstar signal with a gap up, closes above the T line. I mean, that's as many elements of a positive reversal as you can get, and they open up positive the next day, you should be buying immediately. Where's your stop loss? If this was the candle that told us the bulls were in control, they should not be able to close it more than halfway down this candle. If they do, you close out the position. And it shows you right here. Here's a Morningstar signal in the oversold area. Will every single signal work? No. And that's the nice thing about candlesticks. If they don't, it'll show you when it doesn't work. What do we expect after a Morningstar signal? Bullish confirmation. Well, it didn't quite do it. It didn't fail, just didn't quite get above the T line. The next day they couldn't get above the T line. The third day, they're trading more than halfway down this candle. That told me 3 days now they can't get above the T line and confirm the signal. I better be out of this trade and go on to something else. So this was in the Dow not a while back. But here we had a big hammer doji in the oversold area in the Dow, right on the 200-day moving average. What do we suspect could happen the next day? That if they took it up, we'd have a Morningstar signal setting up. We would also know that if we woke up the next morning and the pre-market futures were showing us that they were trading, the futures were trading down, we're still in a downtrend. If they were trading up, we'd know that after a doji and a potential of a Morningstar signal, we could be buying immediately, which we did that day. When the pre-market futures were up, that told us that the bulls had stepped back in. We were buying here and already had huge profits by the time people were still buying at the end of the day. Now, I use this to also show how the moving averages work for us using candlesticks. My late friend David Elliott of Wall Street Teachers came up with the concept of what they call the blue ice failure, where the price falls through the ice, comes up, tries to find the hole that it fell through, can't find it, it fails here, where's it going to go? They've drowned, they're going to the next, or to the bottom of the pond. Now we see a candlestick buy signal. Where's our next potential target? Back up here. We know that once it comes back up, it tests the level. If it fails, where's it going to go? Either back down here or it's going to try to go through. Well, we saw the Morningstar signal right here brought us back up above the T-line. Now it's doing what we call a T-line crunch. they can't close it below the T-line, and the T-line keeps pushing right up to the 50-day moving average. So on this day right here, we have very simple analysis. Either they're going to fail the 50 again and it's time to get out, or we wake up and the pre-market futures are positive. That tells us exactly what's happening as the T-line crunch is pushing us through, and we're buying immediately again on that open, hoping for a new uptrend, which we saw. So it basically allows you to say, all right, I can see a signal. I know exactly what should be done after that signal. If the buyers are in, I want to be in there because the probabilities are in my favor that I'm going to be in a positive trade. Had a big down move, a Morningstar signal, stochastics in the oversold area, a distance away from the T-line, and then a close above the T-line. We're in it until when? Until we start seeing sell signals away from the T-line. Where do you think they're going to come back? They're going to come back and test it. Now, this one is doing what we call a J-hook pattern, which we'll get to. Notice the type of trading that was down here at the 50 and the T-line. Dojis, very indecisive. So if I see a pullback and I'm seeing indecisive trading, that tells me that pullback's not working very much. I'm getting ready to buy because I know if this is wave 1, my J-hook pattern is going to be a pullback, and wave 3 is going to be about equivalent to wave 1. So it allows me that even if I miss this trade and saw this setting up, I know what my next move is going to be. It's going to be about this move right here. These patterns are in the markets every day. No matter what you're trading, you'll see these patterns constantly because this is basically what human nature does all the time. The evening star signal. Big bullish day, a day of indecision. The third day they close more than halfway down this candle. That tells you there's been a reversal. Just a very symmetrical trade. Tells you it's time to start going short. There's your bullish candle, shooting star, doji, bearish candle, closed more than halfway down this candle and below the T-line. It's time to stay short until you see a bullish harami that tells us the selling has stopped in the oversold area. What's going to happen? Well, it's going to come up here, and we've got a bearish engulfing signal. Tells me very simply, if I had covered my shorts here, I see a bearish engulfing signal. If it opened lower, I'm re-shorting. In this case, they close it above the T-line. I know I should be going long until I see a sell signal and a close below the T-line. This is not rocket science. This is just knowing what each signal is representing about human nature. The strongest of all the signals is the kicker signal. You're in a downtrend. They open the last day here, close it down here. The next day they gap it up at or above the previous day's open and go the opposite direction. They've kicked the investor sentiment in the opposite direction. Uptrend, you see it open here, close up here. The next day they open down here. And this used to be me. Uptrend, I'm happy, I'm ready to buy new things, I'm going to make big profits. Then they gap it down here, and I'm thinking, oh, man, I gave back a lot of my profits. I'm going to hang on to it. Maybe they'll bring it back up where I can get out of it. But whatever news was,
and in Forex, Steve,
hoping.
What's interesting is that the signal will be a little bit different in Forex, in my experience, because we don't have that much of a significant gap in Forex on a regular basis. What a currency trader can look for is any open that is any kind of a gap like that. So it doesn't have to actually open downward at the open of the previous day's candle, but it could actually open halfway down, for example, and that would be really significant because there's so much liquidity in the world of currency trading. If it opens halfway down even, it's exactly the same signal.
Right, and it's the same concept, too, that if you're in an uptrend and you're now up in an overbought condition, one of my basic rules is they should not be able to trade it back below the open of the previous day's candle.
Yeah, that's so true.
That's where my stop is. So the bigger, now, again, this isn't as pertinent for Forex trading, but if you're studying, instead of just watching the Forex charts, if you happen to analyze each of the currencies that you're trading on an individual chart basis, and you see these patterns, at least you know what might be happening as those trends as a cross against that other currency. The bigger this gap up, the more compelling your uptrend is going to be. And this is again back in the stock area. A lot of people say, I don't want to buy a stock that's already up 5, 10, 15, 20%. Well, if you can see there was a reversal candlestick signal, that means there's going to be a lot of potential past that. Again, this is me, that I'm hoping this is going to break out to the upside and it opens down here, and I'm thinking, oh man, I'm going to hope that it gets up to this level, and then I'd hang on to it all the way down here. Now at least I know that when I see it open down here, my first thing to do is close it immediately.
Yeah, and that simple rule for people who want a review of that rule, once again, if you're in an uptrend, that final green candle there, what Steve is saying is that we shouldn't be able to open below the open of that green candle. We shouldn't be able to do that, and that is an incredibly bearish signal. And in the world of currency trading, any open below even the close of that green candle is going to mean the exact same thing, because there's so much liquidity in the market. In currency trading, usually the open of one candle is exactly at the close of the previous candle. In this case, case, we would look for something bigger than that.
Right. So the gaps in trading, the Forex is as prevalent. But if you're looking at an individual side of a trade and see gaps or a gap occurring in one of the currencies, at least you know what it might do against the other side of that trade. So again, here's the DOJI followed by a gap up. That's your best friend. Let me see if I can. Oops, I'm getting things all over the page here. DOJI followed by a gap up is going to start a very, very strong uptrend. Now, in Forex trading, just as any other trading, patterns set up. And if you know what the candlestick individual signals are representing, then you can see what it's formulating as far as a series of patterns. This is the type of thing we're looking for in any type of trading style, is where we see a J-hook pattern set up. Do we always get into positions where we're in at 15 and out at 45 3 days later? Not always, but with candlesticks, it puts us in positions where that probability is much greater that we're going to be in that type of situation. And that's what I have found through the years, is that I'm making good money, not because I'm any stock picker or that I'm buying, I've analyzed that lean hogs or live cattle or soybeans are doing anything fundamentally different. All I'm doing is analyzing what's going on in investor sentiment, which is usually the decision-making of people that are a lot more in the know of what's going on than me. All I'm doing is seeing what they're doing on a much more graphic basis. So I know how to identify pullbacks versus reversals, because that's, again, if it's time to take profits after a strong price move, I can watch for a J-hook pattern. The J-hook pattern comes back, shows indecisive trading, and starts back up. I know this move is going to be equivalent to this move. If I know that, I can trade options, I can do spreads, and I know when to start looking for profit taking. That about somewhere up here, the same move here, I want to start watching for candlestick sell signals. If I know a fry pan bottom, which looks like a fry pan bottom, remember, we've been talking most of the signals that if you see signals where your stochastics are now in the overbought condition, that's the time to start taking profits. However, with a fry pan bottom and some of the other patterns, it's going to break out when everything gets overbought. Where does the exuberance come into trading? Notice right here, it gapped out through the top of this fry pan bottom, gave us this result. That's what we expect from a fry pan bottom. Just recently, we had this slow fry pan bottom. We get price moves like this. This is not, again, anything that you have to go out and hunt for. These situations are occurring every single day where we can identify rounding bottoms and expect a big price move. This is going on right now. This is Omar. You can see the nice fry pan bottom. You couldn't trade this fry pan bottom because it was just too junky to trade. But right as it started, we had a breakout. Now, this is 3 days ago when this broke out. We're also trading ARNA. We had a fry pan bottom here. Notice it gapped up from a doji, very bullish. Closed above this level. Gave us a very strong price move. Profit taking right back to the T-line. And now we were getting set up again because look at the little rounding bottom. Yesterday it broke out. Today had another big day. So we're just picking up situations. ECYT is another one that just now, this fry pan bottom, stayed right with the T-line, closed above the 200, which is one resistance level, closed right above this the beginning of this. This tells me I'm in the position where there's a high probability there's going to be a breakout. We know the further you move away from the T-line, the higher the probability that when you start seeing sell signals, it's time to take profits. The T-line works very effectively. You see a buy signal, you can sleep at night until you see a candlestick sell signal and a close below the T-line. Took our profits here. Was this trade done? Sure was, except now they brought it right back to the 50. They did a left-right combination, closed above the T-line. We're buying again because the Japanese rice traders say, let the market tell you what the market is doing. Well, the market on this one said once it gets above the T-line, it stays above the T-line. We made huge profits with this. Again, sometimes it looks a little bit shaky, but until they could close it below the T-line, we're hanging on to it. The Dow 10-minute chart looks just the same as the Dow 1-minute chart or the Dow 60-day chart. I'm sorry, 60-minute chart. They all have the same factors on here that makes for very easy trading. I trade a lot of the commodities, the meats, the grains, the sauce, and I use the 10-minute chart, and when I see the 10-minute chart setting up, I move to my 5-minute and my 1-minute chart to make the execution. We, not long ago, traded Mako because of the kicker signal. Gave us a good price move. Here's a fry pan bottom that we got into because we knew that we had a fry pan bottom. We didn't know when to buy, so it was very simple to put a buy stop right up here. But if it came up through that level, we were breaking out and catching the move at the right time. This is what we call a flutter kicker. Kicker signal where we have a dark candle. The next day they gap it up above the previous day's open, but all they do is a doji. Except we know the simple rule of a doji, that they're going to move it in the direction of how they open it after a doji. So if they're opening it positive, you're buying immediately because we know it's moving in that direction, number one. So number two, if you took the doji out of here, you'd have a good strong kicker signal, which is going to start a strong uptrend. AVII broke out through this little rounding bottom, doji right on the 200-day moving average, which told us very simply if they opened up positive, the 200-day moving average wasn't acting as resistance anymore, and you had a breakout of this rounding bottom. It just sets you up with good probabilities of when to be in a position. This is what we call the cradle pattern. You have a downtrend, a big candle, trades very indecisively for 4, 5, 6, 7 days. Then you have the big, this is the headboard, this is the bed, this is the footboard, this is the cradle, kind of hanging down between two trends. Usually your trend over here is going to be a very strong uptrend. We're looking for buy signals. Moving up, away from the 50-day moving average. When we see it move back to the 50-day moving average and you start seeing buy signals, look for the breakout of this trend. That tells you that this is wave 1, wave 2. We're starting into wave 3. Bearish Harami. This is crude oil not too long ago. Failed right here at the 50. Closed below the T-line. We're in a downtrend until they can close back up above the T-line. Makes it very easy for analyzing a trend. This is the Dow not too long ago. Notice what we had up here. Hanging man, bearish candle, confirmation, an evening star type signal, and then a trade. We're trading back below the T-line. That basically told us they couldn't get up above this level, that we were going to be in a downtrend for a while. And this is, again, that dumpling top, opposite of a rounding bottom, that you see it rolling over slowly, and then when they start selling off, you stay short until you see a buy signal and it closes back up above the T-line. Kicker signal to the downside. Market's rolling over, start going short. This tells you they not only are getting out of this position, but they've kicked it in this direction. Whoops, we saw that one. Saw that one. Oops, I got a few repeats. Also, knowing which candlestick signals are signals, you also know which signals aren't signals. I usually ask people what this signal is right here, and most people say, well, that's a piercing signal. No, a piercing signal has to open below the previous day's low and close more than halfway up. So what are we seeing here? We're seeing a failure of the 200, and now we're seeing an up day, not a reversal signal, just an up day. What's that tell us? It tells us that probably they're going to take it up, but not with very much force. Now they get back up to the 200. We have a bearish engulfing. If we were short down here and covered, we're reshorting here. Same scenario. This was not a reversal. This was just a bounce. We're looking for the buy signals, the patterns, the breakouts, so that when we see a breakout like this, even though our stochastics are up toward the overbought area, we're still buying so that we can take advantage of these strong price moves. This is not rocket science. This is just putting the probabilities in your favor. So I think that's about all I got, except I have discovered through many years of trying to teach people how to use candlesticks that most people are afraid to. They think it takes too long to learn and they're too difficult. Well, I've made it very simple, number one, because it is very simple. And so I've Rob's group, I'm giving a special that they can't refuse. For $12, you get my 12 major signal video. I did these years ago. I go through each of the 12 major signals with each video about 45 minutes long, telling you where they work and why they work. If you understand, or if you can recognize recognize a signal and understand why it's occurring, what the investor sentiment was that created it, you've got now a great understanding of how price movements occurred. That usually retails for $581. We're going to sell it for $12. But wait, there's more.
I knew you were going to say that.
You also get a 30-day free trial to our website. Now, our website has a chat room that runs every single day while the markets are open. Monday nights, I do a training session where we go through what commodities are working, what currencies are working, what stocks are working, what patterns are most prominent during that week. We do the same thing free for everybody on Thursday night. I put out 2 or 3 stock picks every day, not so that people have stock picks, but so that you can go to the video and see what the rationale was or what the analysis was for those picks to be made.
Can I interrupt you just for a minute? Are you telling
Certainly.
me that there's 8 hours? I'm seriously blown away. I've done probably 40 of these webinars, Steve, and I've never seen anybody end it by saying they're going to give 8 hours of instruction for $12. Are you serious?
I'm serious. This is I've been doing this for I had the website set up at 2000 and been trying to pull people in because every time I show people candlesticks, it's so simple that my rhetorical question today is, why isn't everybody using candlestick analysis?
Well,
so
I'll tell you something. There's
one
other time I did a webinar like this, and it was so good I bought it. In most of the other situations, it was something, it was a great presentation, and it was a great fit for a lot of people. This is the second time I'm gonna go buy this, Steve. This is incredible. I don't know what you've got going on behind the curtain here, but that's an incredible offer. Most people are going to get on and say, I'm going to discount it to $400 or something like that. But this is something that I think if you're listening to the recording or if you're watching this live and you're a currency trader and you've followed me over the years, there's a lot of people here tonight that have been with me for a long, long time. I don't know how in the world you go wrong, and I'm speaking from the bottom of my heart. I don't know how you go wrong. You saw tonight how much information Steve was sharing, and I am truly, Steve, I am totally blown away that I know there's other things that you offer. I know that. And you ought to be ready for it, everyone, that this isn't the only thing that Steve ever offers. But if this is the only thing this is the only exposure you ever get to Steve, you ought to do it. You ought to take the opportunity here, because this is clearly, you've already proven that you don't hide anything. You just go for the throat. This webinar started and you didn't let up for 65 minutes. So,
all right, well, what I've discovered is that if people will take the time, as I say, no matter what your trading program is or what techniques you're using, if you put candlesticks on top of it, it's going to make it that much more clear for you to see what's.
So, Steve, if you don't mind, I want to let everybody know. I'm going to let you continue, and I didn't mean to interrupt you, but I had to say that I'm putting the link through on the webinar software right now. You can see the link on the screen in front of you. I'm putting the link in the webinar software, and following this webinar within the next 7 to 10 days, I'll send 3 to 4 reminders to you with the recording in it, with the link that you have here. I don't know if you're willing to keep that link up that long, but I will send this out tonight. I'll send this out also tomorrow as well. Steve, please continue.
All right. Well, with that, for 30 days, you get free access to our website, and then it kicks in that if you want to stay, you stay as a member, which our fee is $97. But we're not trying to trick people into becoming members to our website. It's something that after you analyze candlesticks, if it's something you don't want to do, we're not trying to trick people and all of a sudden you're being billed. We put out a notice in 30 days saying, thanks for looking at the site for 30 days. If you don't want to continue, opt out here. But as I say, once you learn candlesticks and you put it over on any type of trading you're doing, you're going to greatly improve your probabilities, or at least your visual ability to see where it's the right time to be buying and the right time to be selling.
Yeah, that's absolutely great
So
stuff.
with that,
there's a lot of people asking in what format the videos come, and I'm assuming that once they purchase this, they're available to watch online, so they're not going to get shipped a DVD or anything like that.
No, there's immediate download.
Right.
So you pay your $12 and you can be. I'm
going to do it tonight.
Okay.
I would do it right now, but I would interrupt the recording. I actually pulled up the web page during the recording, so if you're watching the recording, you saw me do it, and then I realized I was distracting everyone on the recording from the screen. But I'm going to do this tonight. I think if you're here tonight and if you're watching the recording, it's $12. You cannot go wrong. I think that's like
you can't go wrong.
A little bit more than $1 per hour of video.
That's about right.
I'm hearing people say,
some people sometimes.
Hearing people say they already have it. They just ordered it. It's in their email already, so they're already going there. Steve, I put the link in the webinar software for people wondering. It's in the chat box on the webinar software. And once again, if you're having trouble clicking that link, I'll send that out tonight to you as well.
Okay. All right. So if anybody has questions, I usually end it by telling people you don't have to overanalyze candlesticks. It's somewhat like the lady that brings her parakeet into the vet and lays it on the table and it's just laying there dead. And the vet says, "Ma'am, I'm sorry, your parakeet's dead." She goes, "Oh, no, isn't there something you do to check? He's been my best buddy for years." He goes, "All right." So he goes out to the back of his clinic and brings in a big cat, lays the cat next to the parakeet on the table. Cat sniffs it, looks up at the vet, kind of shakes its head and goes, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh, no, isn't there something out just to make sure? He's been such a good friend." He goes, "All right," and brings in a great big Labrador retriever, comes bounding in, puts his paws up on the table, sniffs the bird, looks up at the vet, kind of shakes his head. He goes, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh." And they go out front to the front desk, and he goes, "All right, well, that'll be $250. She goes, "You're charging me $250 just to tell me my parakeet's dead?" He goes, "No, ma'am, I would have done that for $18. Then he wanted a CAT scan and a lab report after that. So I tell people, you don't have to overanalyze candlesticks. It's just common sense put into a graphic depiction. So with that, Rob, if people have questions, tell them to fire away. I'll stay here as long as people need things clarified.
Well, that's great. Why don't we stay for another 5 minutes or so, and then we'll let everybody get back to their families. And, of course, you've already spent a lot of time here tonight. I want to say, for the record again, you've been extraordinarily generous. The offer is amazing. and I tend to get pretty excited pretty quickly, and everybody here knows that. You're all my friends. I've never seen anybody that I've done a webinar with blow through that many charts and share that much info. I've never seen that, ever. It's never happened. And then to top it all off, you didn't end it with some offer for... It's amazing. I'm blown away, and I'm just honored that you've been here. If you're in the webinar right now, don't wait any longer. Just click the link. I mean, it's $12. I mean, really, you click it now. Get the 8 hours. If the 8 hours are anything like what you just watched over the last hour, it's just amazing, and it's totally worth your time, and it's totally worth that investment. It's a small investment to make, and then you're going to get 30 days on the site too. I can't wait. I swear I'm ready to finish the webinar and avoid the questions so I can do this myself. And I've never said that, Steve, and a lot of people that are here know I've never said that. I've said thanks everyone, goodbye. I'm going to jump on there as well. Lots of positive comments. I'm not going to let your head get too big, Steve, but a lot of very positive comments. I'm really happy to see all those. Can review this webinar later. Yes, I've recorded it. I will send you all a link to this webinar recording. And I'm just going to say, in the next 48 hours, I'll send you 2 emails at least to remind you to watch the recording and take Steve up on the offer. I'll try to get him to keep it open for 24 or 48 hours. I'm just getting a lot of comments, Steve, from people that just say how fantastic it was. So,
all right. As I say, I was the worst investor in the world, and the reason I get excited showing people this is because I know there's lots of people like me that probably learned how to invest the wrong way. So it took me quite a while to unlearn, and not only unlearn, but then kind of get through your own mental hang-ups. And the more I kept doing this, the more I kept saying that just if you did what the charts tell you, the probabilities of being right are so much greater that now I'm consistently making profits, whereas I used to consistently contribute to the market.
Well, it's been a joy to have you here. I hate to have you go because I feel like now I could just keep asking you questions forever, and I know that you would stay. I want to thank everyone for coming. Congratulations on getting lucky here on just a fantastic presentation. I mean, for every 10 webinars you go to on the web about trading, one of those webinars is a home run, and certainly that's exactly what happened here tonight. Steve, I appreciate your time, your effort, your preparation was immense. The attention to detail was extraordinary, and the offer is, like I said, it's unimaginable in a world full of people who just want to end the webinar and ask for $150 to $1,000. You did exactly the opposite. So I hope we can bring you back again sometime in the near future. But as for now, everyone, thanks for being here tonight. Steve, thank you once again. We so much appreciate your time.
No, thank you, Rob. Thank you, everybody. Have a good evening.
And you'll be hearing from me, everyone, multiple times within the next 7 to 10 days. You can expect to hear from me with the recording multiple times so you don't miss it, and also a word or two from Steve by email, perhaps. I'll share your email addresses with him so he can get in touch with you. Also, thanks again. Have a great evening, everyone. Enjoy your families and your time, and good luck trading.
Thank you.